Hello, viewers. Hope you all are doing good. This is Arjun Vijay from AlphaStreet, and today we are speaking with Tim Murphy, CFO of Repay Holdings. So,
All right.
Tim, firstly, just briefly tell us how Repay is different from other payment providers out there.
Yeah, so we're unique in the verticals we serve. So we serve some very large underpenetrated verticals like auto finance and business to business payments. And in those verticals, we're very integrated with the key software providers in those large growing markets. And so our payment technology is very proprietary and different and very specific to serving the needs of the merchants in those verticals. And the integrations we have, I think, are also pretty unique. So that's how we typically go to market and differentiate in those types of verticals.
Okay. Tim, when COVID hit last year, we saw many companies, rushing to digitize their operations. What were your observations and learnings from the pandemic year?
Yeah, so we saw a lot of shifts accelerate. We saw the shift happening, the move to digital payments prior to COVID, but COVID really accelerated a lot of those trends, specifically in the business to business payments world, where AP clerks were no longer in the office and they weren't able to write checks and send checks, so they had to move electronic. We saw that in our own business where we had to move our AP department electronic, and we're serving businesses that have now accelerated all of that adoption of technology for example, for electronic payables. So I think those are trends that were starting to happen and were underway prior to COVID, but it probably, they pushed them forward 18 to 24 months. And I don't see that going backward. I don't see companies looking to become less efficient and less digital now. I see everybody moving toward more digital, and COVID just accelerated that. So we greatly benefited from that. Those trends were, like I said, they were happening, just greatly accelerated.
And do you expect those trends to continue, or do you think those were just one-off trends that you witnessed during a pandemic year?
No. I expect them to continue. Like I said, I mean, for example, in our own, Repay's AP department, we've moved all to electronic payments to the extent we can, and I don't see us going back to manual check writing processes and reconciliation manually. All of those things that we were forced to do because of COVID, we're now really embracing. And I think there's thousands and thousands of businesses across the country doing the same thing. And so that's going to continue to happen and maybe even accelerate further now that people are comfortable working in that environment.
All right, great. Tim, tell us a bit about the themes that you're witnessing on the B2B space in specific. And what are the areas that you feel are underpenetrated where you see a possibility for further growth?
Yeah, so business to business payments have just generally lagged, consumer payments. The consumer payments market had adopted card payments, much earlier, and they've been, consumers have been using cards to make payments in their daily lives for decades. And I think B2B has just sort of really taken off in the last several years because of the technology and all the different pieces of businesses, payables or receivables departments are becoming digitized and using technology. And so we're in both sides of the transaction. So, we're able to facilitate a business accepting a card payment from another business, and we're also able to help our customers send electronic payments to their vendors using virtual cards. And so we can do both the acceptance, which is AR, and then the payables, which is AP. And we see both of those very underpenetrated from a card perspective. And we think that's a very, very large market. And that's why we're spending a lot of resources there. It's our fastest growing vertical. And again, we're on both sides, which is pretty unique. We don't think there's a lot of companies that can do both the AR and the AP. And we're also integrated with the key accounting systems to be able to do both. And so that's just a very large space that it's taken a long time to get up the curve from a digital payments perspective, but I think it's finally there. And which is, again, why we're focused on and spending a lot of investment dollars there to help grow that part of our business.
When you reported earnings last month, you had raised your full year guidance. Do you see those tailwinds continuing to act on your financials going into this quarter?
Yes, yeah, we feel good about the trends we see. What we feel really good about is what we see for next year. We're still kind of in this Delta variant phase, which hopefully will we'll be out of soon and normalize into 2022. So we feel good about what we're seeing in Q3 and Q4, but really even more excited about what we see for the full year of 2022, as we hope a lot of this normalizes and these trends, get back to full acceleration across all parts of our business, not just some of the digital adoption trends I mentioned, but just normalization of activity across all verticals. Healthcare is an area where we're both in the acceptance part of the healthcare business, but also the payables part of the business. And as hospitals have been unfortunately bogged down again with Delta variant and facing some difficult times, but we hope that there's some pent up demand within hospitals that will benefit from going into next year as well. So that's another part of our business that we like and we're excited about in terms of healthcare. And so feel good about this quarter and the rest of this year, but even more excited about next year.
All right, makes sense. You're a holding company and you're very active on the M&A side. Obviously, that requires a lot of funding. I'm just trying to understand your funding strategy and how much of debt you intend to retain on your balance sheet.
Yeah, so earlier this year in January, we completed a concurrent common stock and convertible debt offering. And so we have $440 million of debt today, about $120 million of cash, so called $320 million of net debt, puts us at about 2.8 times net leverage. So very comfortable level for us. We have a $125 million undrawn revolver, so bank revolver debt, fully undrawn. So we have capacity to do additional M&A just with our existing balance sheet. We think we could comfortably stretch up to maybe 4 times net leverage, maybe a little bit above 4 times net leverage, knowing that our target would be to bring that back down to around 3 to 3.5 times within 12 to 18 months, and we have the capacity to do that. We did, like I said, tap the equity markets as part of that deal in January, and we've used that for financing purposes as well. I think for the near term, we'd probably be more focused on using our balance sheet and the debt and cash we have and the capacity we have, like I just mentioned. And if it was a much, much larger deal in the future, we'd have to consider equity again. But for now, I think we're focused more on using debt and cash.
Great. Lastly, just one more question, Tim. What is going to be the management's focus for the next 12 to 24 months?
Yeah, so like I mentioned earlier, our fastest growing part of our business is B2B. So we're focused on investing there. We're focused on continuing to increase organic growth. We want to see organic growth in the high teens to 20%. And then I think we could tack on some M&A using our existing balance sheet to facilitate even faster growth. And that's something we've been successful doing in the past. To your point, we've made several acquisitions. All of these are intended to be very strategic and intentional and put us in verticals where there's a very large addressable market that has a shift from paper and legacy forms of payment to more digital forms and provide an even longer runway for organic growth. So I think the focus is on investing in areas like B2B, facilitating even faster organic growth, and then supplementing that with strategic M&A.
All right. Terrific, Tim. Thanks again for your time. It was wonderful listening about your views and ideas.
Absolutely. Nice to speak with you. Thanks for your time.